From our side, just to start off by talking about what we believe are the 6 key messages that are within our results. And the results are delivered in a particular context of probably 2 halves in 2024. The first half of 2024 characterized by a very sharp devaluation of the Naira. The Naira closed in end 2023 at 907. And as the start of January last year, many of you remember it went to 1300, and at the peak was at actually 1900. So that sharp devaluation characterized quite a lot of our results in the first half. The second half of the year is still currency volatility, but much more muted. And we also benefited in the second half of the year with a renegotiated set of tower contracts in Nigeria with IHS as well as with ATC. And inflation was also starting to mute. So there's really a tale of 2 halves. And the underlying performance that we had consistently delivered started to bear and show fruits in the second half of the year. And as you see in our results, and Tsulu will present this, H1 over H2, steady earnings, cash flow, cash upstreaming, and better leverage outcomes coming. So giving us some momentum as we exit 2024. The second message is really that the commercial momentum is still driven by the 2 structural growth underpins we see in our own investment case, which is data growing pretty strongly. We saw data growth growing at 21.9%, and Sulu will take us through that. And then the fintech business, much higher quality growth that we achieved. The base didn't grow as much, but actually the service revenue and the margins were expanding very nicely. And you'll see there that the growth is around 28.5% on service revenue. The third message is we are progressing with strategy and its execution. The first point that we'll cover is localizations. We've completed localizations in Uganda and Ghana. And so those were outstanding strategic initiatives, and they are now completed. We've made really solid progress in terms of simplifying the portfolio and exiting certain markets. We're out of Afghanistan last year, out of Guinea-Bissau, and out of Guinea-Conakry. And on the fintech side, continuing to expand the ecosystem, progressing with structural separations, and deepening the partnerships that we have. The fourth, Tsulu will cover in a lot more detail, is the balance sheet. The balance sheet, again, experienced the effects of the 2 halves of last year. You well remember that the holdco leverage went above our guidance, 1.6 times at the end of the half year. By the end of the year, we're back in guidance at 1.4. And also the cash upstreaming was much better in the second half. And that also helped, give the business a healthy liquidity position, as Tsulu will cover. Fifth message, guidance maintained overall for the group, and we've reinstated Nigeria guidance. We suspended Nigeria guidance last year because of the uncertainties around the macro, and we feel pretty confident this year that the outlook is more visible, and we are prepared to put our stakes in terms of FY2025 guidance, which we have called out specifically, and then reinstating the guidance. Final message is really about dividends. We had guided for minimum dividends of 330 cents, having assessed, the usual solvency, liquidity, and outlook criteria. We felt it's possible. The board on Friday, approved a dividend of 345 cents per share, also signaling an anticipation of a dividend of 370 cents for FY 2025 payable in April 2026. So those are the key messages. And starting with commercial momentum, let me pick up on that one first. And obviously, the commercial momentum in our business is largely driven by data as well as the fintech side. And as I mentioned earlier, a bit more muted growth on the core connectivity business, 2.2% up. And that's in a period where we had the NIN-SIN registration. So we deleted a lot of subscribers in Nigeria so that we could be compliant to meeting the NCC requirements of NIN registration. But actually, the active data subscribers grew, pretty nicely, 7.7%. The data traffic, the demand, and use of our networks continue to grow, pretty strongly there. Same profile on Momo monthly active users. We did quite a lot of work to clean up the base, reduce some of the incentives around commission. We don't count wallets now that are seeded but are not active. So a cleanup of the base has resulted in more muted growth on the base, but actually transaction volumes as well as transaction values continue to grow. So much higher quality growth, which we are very happy with. In terms of the financial highlights, I won't dwell on them too much. Tsulu will cover, but maybe to pick on a couple of KPIs. Service revenue at 13.8, getting much closer to our guidance range of 14 to 16 when we say mid-single digit. And again, a tale of two halves. First half, service revenue was about 12.2, second half 15.5. So starting to see an acceleration coming into the second half and driven by data and fintech. You see the growth levels there. In terms of our earnings, we often shine or put the focus on adjusted headline earnings, which we see as a measure that gives you a sense of underlying earnings momentum in the group. It's still down just on 32%, mainly driven by the sharp devaluation of the Naira, and the sharp devaluation of the Naira generating obviously less reported earnings as we consolidate them up at group. I mean, Tsulu will show a slide what if you were to normalize for translation effects, actually, the business is looking very, very solid.
So if I can just take you through some of the key financial messages from our financial performance, 5 key insights. Firstly, as you can see, we continue to manage the macro impact on our financial results. However, we notably saw a moderation on the effects of in the effects of our numbers in the second half, and these were really headwinds that abated in H2. Secondly, we are pleased to report a positive underlying trajectory in our service revenue growth as well as EBITDA margin. It demonstrates the strength of our operations underpinned by effective execution. Additionally, which is really the third point, was we continue to execute well on our expense efficiency program, and I will share with you later. This program has really helped us to cap the effects of the macro environment, enabling us really to defend our margins. The fourth point on the screen is that we have also been very seen very strong trends in terms of free cash flow and our leverage metrics in the second half of the year. These improvements have aligned with our commitments to the market to really reinforce the strength and flexibility of our financial position. Finally, just to reiterate, is that we have remained disciplined in applying our capital allocation framework, and it has really underpinned our performance and ensured that we are making strategic investments that drive long-term value. So if I can just give you insights into the positive momentum in the second half, as Ralph indicated, you will see the trends on the screen. On our key financial metrics. I will speak to these throughout my presentation, but as you can see, our service revenue growth accelerated in the second half to 15.5%, including MTN Sudan, which started to show more encouraging trajectory, but overall a very pleasing acceleration relative to the 12.1% that we reported on in the first half. In terms of EBITDA, H2 much stronger than H1, again with overall margin improving to 39.9% compared to the 36.5% that we reported at interims. The strong operating performance in H2 is really reflected in our P&L with adjusted headline earnings per share of 443 cents in the second half compared to 373 cents at interims. Similarly, operating free cash flow, as you can see, and this is before spectrum and licenses, was much stronger in the second half, coming at 21.5 billion rand versus 9.9 billion in the first half. And this underpinned the cash upstreaming, which was much stronger, which ultimately supported also the whole leverage that came in within our guided 1.5 times, where we achieved 1.4 times, and an improvement from H1 as well as our Q3 results. So overall on this slide, We show a very strong exit from a financial perspective, which I think puts us on a strong footing as the new year unfolds. So just to take you through some of the financial performance, and before I do that, very briefly on the significant items that have impacted our results again, which Ralph touched on. Firstly, from a macro perspective, starting with the FX volatility and notably the devaluation of the Naira. This had three significant negative effects in our financials, namely upward pressure on FX, blended inflation impacts, as well as the FX losses coming through the finance charges line. But also importantly so is the translation effects in terms of the conversion from local currencies to our reporting currency, the ZAR.